Hello Prince Ali, thank you for purchasing a car from us today.
You are most welcome. I am very excited to get out on the open road.
Now before you leave, I want to let you know you are covered for 3 years under our warranty policy.
Warranty? What in the world is that?
You don't know what a warranty is? Oh my.
This sounds like an extremely interesting subject and want to learn more. How can I do so?
It is indeed an interesting topic, but beware, warranties are a very complex advanced accounting issue. Are you sure you can handle it?
Yes, I can. I have never been so excited in my entire life.
Fantastic. I have just a group of young, energetic, and smart people to explain the complex issue of warranties to you. Sit back and enjoy.
Welcome to our discussion on warranties. Today presenting we have John,
Danghong, Giselle,
Dylan.
In our discussion on warranties, we will be given an overview of the definition, identifying differences in treatment by GAAP and IFRS, discuss accounting quality issues and earnings management issues, give a real-life example of an accounting quality issue with warranties, discuss how to identify issues associated with earnings management and accounting quality, and we will conclude with the implications for the users of financial statements affected by warranties.
So first, I'm going to give a definition of warranties. A warranty is an obligation incurred in connection with the sale of goods or services that may require further performance by the seller after the sale has taken place. An accrued warranty liability and related warranty expense should be recorded at the time the product is sold, only if it is probable that customers will be making claims under the warranty and the amount can be estimated. When work is performed under the warranty coverage, the existing warranty liability will be reduced. Accrued warranty expenses are estimated warranty costs of products that are sold during the accounting period. Warranty costs depend on sales and the failure rate, which is the frequency in which a product is defective. Usually, management uses a percentage of sales, which is based on past experience in the computation of the warranty estimate. Other factors are the coverage of the warranty, which entails the scope and duration. The expected cost of the warranty increases with an increase in coverage, and the expected cost decreases as product quality increases. So next I'll talk about the effects on the financial statements through a simple example. Assume that a car costs $10,000 and the company uses 1% of sales as their failure rate, and the part costs $10 to repair the car. So a simple calculation of $10,000 times 1% times $10 equals 1,000, which is going to be the warranty expense as shown being debited and a warranty liability, which will be credited. During the year, the car needs $400 worth of repairs and is under warranty, so the company reduces the liability by $400 and also reduces inventory by $400. That inventory is used to repair the car. This leaves a liability of $600 for additional repairs during the remainder of the warranty period.
Companies are also required to have a footnote disclosure in the financial statements regarding their warranties. Here's an example from Quantum Corporation of how a disclosure may look like. We begin with prior year's ending balance, add additions, and make any adjustments to prior year figures made by management to get the ending balance. Then, the company should also include a discussion of how they account for their warranties. Not only is this disclosure required under GAAP, but is also included under IFRS. With IFRS, we have identified some minor differences.
One difference between GAAP and IFRS is how you record the estimate of the expense. When estimating warranty expense, management has an upper estimate and a lower estimate. GAAP allows you to record the lower estimate, while IFRS requires that companies report the mean estimate for the expense. Now we're going to talk about accounting quality issues related to warranties.
When complying with GAAP and/or IFRS, financial statements should have high accounting quality, meaning that the reported accounting numbers should reflect the underlying economic reality of the company. Some of the key characteristics of accounting quality that can relate to warranty accruals are comparability, consistency, reliable or faithful representation, and transparency. With comparability, companies within a similar industry typically follow a common trend because similar products have a similar makeup of parts. By changing a warranty policy, it can result in competitive advantage over another company. A way to successfully distinguish themselves from others within the industry is if the product is highly differentiable. So warranties are highly related to product quality. If the quality of a product decreases, then actual cost of warranty claims should increase. One can conclude that it is possible to identify what type of industry the financial statements are reporting are by looking at the notes concerning the warranty accruals. We refer to this as a company fingerprint. Warranties are a good indicator to signal about firm types and future performance. Warranty expense should also be fairly consistent with historical figures. When comparing figures to past reports, if there are significant differences or changes in accounting policy applied to warranties, it may be an indication that accounting quality may be affected. Figures reported in the financial statement should also be highly reliable or faithfully representative. Typically, companies estimate the warranty expense based on percentage of actual sales, but one should question the reliability of the data to identify any areas where there are potential for management to adversely adjust or mark up warranty reserves. One must also identify if figures were based on imperfect data or alternative market structure, because industries can face volatile conditions that companies may not be expecting. Lastly, with transparency issues, disclosures to the financial statements regarding warranty accruals should be highly transparent. FIN 45 requires warranty disclosure in the financial statement to help users, because if disclosures are difficult to understand or do not provide enough information, this could mislead investors. Disclosures are useful for identifying how a company reports their warranty accruals. Accounting quality is very important for determining the reliability of the financial statements. If accounting quality suffers, the potential for earnings management is increased.
Okay, the incentive for earnings management is from both internal and external. The internal reason is to meet targets, which can be meet budget numbers and required numbers. Budget numbers are set by the company to manage the operations. Not meeting budget numbers makes a person, department, or company below the budget, which sounds unfavorable. So all the managers are intended to achieve or exceed the budget earnings. The required number is closely related to the employee's performance. If the person not meet required numbers, then they may get a bonus. From the external perspective, external analysis may have made some predictions. Also, some other external parties may expect the company to meet or exceed the previous projected numbers. So if the company current year income is not meeting the target, they will underestimate the warranty expense to increase the current income. Besides that, investors like to see constant growth of company, so the company tends to smooth the income. It also a pressure to reach a debt covenant. So for warranties, if they expect the income for the future will decrease, they intend to overestimate warranty expense this period to decrease the current income and create an additional liability on the balance sheet that can be used to absorb future warranty costs in order to reduce future expense. We will talk about this in details by analyzing specific cookie jar example. During the year one, the X company managed run their business very well, and their earnings showed a 20% increase compared to the prior year. During the year two, the business is not running as well as before, but we assume the company still be able to maintain 20% high growth rate. At the end of the year two, the company did forecast for year three and found out the company growth rate for year three will significantly decrease to 13%. In order to make the earnings look smooth, the company decided to use cookie jar accounting. They artificially increased its warranty reserve by applying unrealistic assumptions at year two. They increased the warranty reserve liability without the additional expense of $4,800, so the growth rate for year two is decreased to 18%. During the year three, without applying the cookie jar accounting, the company has earnings growth rate of 13%. To meet the expectation and show the smooth income, management decided to adjust the warranty reserve assumptions and reverse 4,800 additional warranty expense recognized in year 2. This reverse creates an additional income of 4,800 for year 3 and gets 16.6% earnings growth instead of 13%. So now X company earnings looks very smooth, which can help them attract more investors. This is exactly how managers use warranty to manage earnings. This is not the only way to manage earnings. The company can also manage earnings by accrue the warranty expense to boost the current year income, which will be giving more details by Giselle.
One company that was suspected of underaccruing their earnings was Dell. Dell has issues relating to warranty reporting is Dell Corporation. In 2006, Dell was investigated by the SEC for suspicion on earnings management. Users felt that accounting methods were unusual because Dell lumped together their basic and extended warranties. By lumping the different type of warranties, accounting quality suffered because accounting rules differ for extended warranties specifically. This makes Dell's disclosure not transparent because their accounting method is difficult to identify. Dell was accused of underaccruing warranty expenses to improve income, which improved earnings per share to meet analyst expectations.
Now we're going to take a look at how to identify issues associated with earnings management and accounting quality. We're first going to take a look at some common trends. Managers often underaccrue when times are bad to boost earnings and overaccrue when times are good in order to increase cookie jar reserve. Accounting quality and earnings management issues can also be identified by comparing current warranty expense as a percentage of sales with historical figures, as well as with comparable companies in the same industry. An indicator of poor accounting quality and possible earnings management is comparing the accrual rate and the claims rate. If there are significant differences between the two, further analysis should be applied as to why estimates significantly differ from actual results. For example, period from 2007 to 2009. Now we're going to take a look at the implications for users of financial statements that have been affected by earnings management and accounting quality issues related to warranties. If managers increase the estimate for warranty expense, this will decrease the expense on the income statement, thus reducing net income. If the estimate for warranty expense is decreased, the expense will be smaller on the income statement, resulting in an increase in net income. The balance sheet will also be affected, as liabilities will either be under or overestimated or overstated depending on the decisions of management. Investors make decisions based on ratios which include the warranty liability and expense, and will be misled if management smooths earnings through the use of warranty estimation. Thank you for listening to our discussion on warranties.
Oh my goodness, that was one of the most informative discussions I have ever been a part of.
I told you.
I feel like I could take over the world with all the knowledge that John, Danhong, Giselle, and Dylan just dropped on me.
I am glad you are satisfied, Prince Ali. Is there anything else I can do for you?
I have one more question. After analyzing your financial statements, it looks like your warranty liability is significantly lower than the industry standard. Is there earnings management going on?
Darn, you got us. Our young, energetic, and smart people have taught you way too much.